G'day expats and welcome to another episode of Expat Chat. We're doing a special episode today where we are joined by our guest, Edward Cole, who is one of the partners of Cross-Border Financial Planning USA. G'day, Ed. How are you?
Yeah, good mate. And yourself?
Yeah, good, mate. It's a lovely Wednesday morning here on the Gold Coast, and spring's right into it. We're sort of experiencing a bit of a strange heat wave at the moment, but I mean, you can't really whinge about the weather when we're on the Gold Coast. How about you, mate? Whereabouts are you based?
So I'm based over in Los Angeles. As you can tell from my accent, not from here originally. Uh, from the UK initially. It's actually just got back from a trip from over there and a few days in France, watching a couple
Yep.
of the World Cup games.
Beautiful.
So, but yeah, moved out here and now part of Cross-Border Financial Planning USA.
That's it, man. And you really embody an expat because obviously you're from the UK, you're in the US now, you're focusing on your particular niche. So I really appreciate you jumping on for today's episode where we're going to deep dive a little bit into just US retirement accounts. But before we jump into that, can you just give us a bit of an oversight on, or I suppose overview, I should say, of cross-border financial planning USA?
Sure. So Cross-Border Financial Planning USA is really set up to help with expats and globally mobile individuals and families with US assets. So we have a lot of clients who are here in the US or internationals, clients and families, but also a lot of clients who are outside of the US and may have still got assets left in the US. So we help a range of clients. The common denominator among them all is that there tends to be that international component to them.
Yeah, exactly right. And I know personally I share a few clients with Ed, so that's why I'm getting him on today's podcast so we can deep dive a little bit into that US specific topic. Before we jump into it, a quick disclaimer to our listeners and YouTube viewers. Anything you hear today on today's episode is general in nature and should only be consumed for information and entertainment purposes only. Anything we discuss should not be seen or taken as any form of advice. Should you need advice, please feel free to reach out to the Atlas Wealth Group or Cross-Border Financial Planning USA. Now let's jump into it. Retirement accounts, Ed. What are some types of US retirement accounts which would be quite common for expats to come across?
Sure. So there's quite a number of different retirement accounts in the US. You've got some that's just the 403b, you've got defined benefit plans, SEP IRAs, simple IRAs. These are all different types of accounts. But I think probably the three that we come across most of all, particularly among expats, would be your 401k, your traditional IRA, and your Roth IRA.
Yeah, absolutely. And I know a question I often get from a lot of my clients that have either just moved to the US or are sort of signing the contract for their new US employer. They often get asked, "Oh, do I opt into, the 401k plan or do I not? What does it mean? I don't know how long I'm going to be here." Can you share a bit of insight into just a general overview of maybe some of the intricacies between the plans?
Yeah, so I mean, one of the main differences between, say, the 401k and your IRAs and your Roth IRAs is that 401ks are offered through employers, and the IRA and Roth IRA are individual, so created by the individual. The probably the key difference is the contribution limits.
Mm,
I would say, as well as the fact that 401ks, you've got those, not always, but often you've got employer contributions going into the plan, which is one of the main reasons that a lot of people will partake in their 401k plan offered by their employer. So, I mean, just as an example, the contribution limit for employees in a 401k. So you've got for the employees, it's $22,500 or
mhm,
$30,000 if you're over the age of 50.
mhm.
And the total plan contribution by both the employee and the employer, that's 66,000. That's for 2023, and 73,500 for employees who are over the age of 50.
Wow,
Um,
that's a
the
lot, actually. That's a lot. That's a lot that can get into those plans. I'm just comparing it back to Australia and superannuation because right now in Australia, we've got concessional contributions, which are mainly your sort of employer ones, which is 27,500. You can get more into them, but then you get hit with a bit of a penalty tax when you're an Australian employee here, normal tax resident. So those amounts, that's huge actually, especially when you factor US dollars in the exchange rate right now.
Yeah, definitely. I mean, it's also important to know that you can't exceed 100% of the employee's annual compensation, but of course, if they are earning that much, then they can go for the full amount. It's quite different for the IRAs. They've got their contribution limits quite a bit lower, so they're only allowing for $6,500 per year, or $7,500 if you're 50 and older. Again, assuming that your earned income is at least 6.5 or 7.5. I think one of the differences here, though, is that the contribution, how much can be deducted from your tax return, depends on the filing status, your income level, and whether the individual and their spouse is actually already covered by a plan at work.
Yep.
So, I mean, there's quite a few different variables there, but if neither spouse is covered by a work plan, then a full deduction up to the contribution limit can be claimed regardless of income. But if your filing status is married, filing separately, and either spouse is covered by a plan at work, then your income only actually needs to be over 10,000 for there to be no tax deduction.
Okay.
So there's quite a difference really between the what you can put into your IRAs and your 401ks.
Yeah, absolutely. One thing you mentioned before was the sort of common ones are IRAs, Roths, and then 401ks. Can you give me a bit more of an understanding of what a Roth is and how it's different from, say, a 401k or just a straightforward IRA?
Yeah, so Roth IRA, so the limits are same as the traditional IRA. So again, you're 6.5 for under 50s and 7.5, 50 and older. Again, as long as your earned income is at those levels. The one difference there is it's not subject to the same restrictions based on work plan coverage. So if you, unlike the traditional IRA, where if you have that option to enter into a work plan, then that can limit how much you can contribute, but not the case with the Roth IRA. Probably the biggest difference between them, though, is just really the tax treatment. So with a traditional IRA and as a 401k, you're getting your tax relief when the money goes into the plan. So when you put the money in, you can deduct that from your taxes. And then when you withdraw the money, then taxable in the future. Whereas with a Roth IRA, the difference being there's no tax relief when you put the money into the plan, but equally when you pull out the money, there's no tax applied on that. We're talking from a US standpoint just at this point in time, but so that's probably one of the main differences. Throughout all of the plans, though, you've got tax deferred, well, no tax on the plan whilst it's inside of it.
Yeah, that makes sense. So, I mean, for our listeners, it sounds like you're getting a tax deduction, for some of those plans, your 401ks and your straightforward IRAs to a degree. And as you said, it depends on your filing status, how much can actually be used. And then it's growing tax deferred in, I guess you could say, a tax-free environment, but then you're taxed on the withdrawals in the future. And I'm sure there's other eligibility for that. So we'll jump into that soon. And then the Roth can be attractive, I reckon, for those expats which have an intention of staying in the US. And I know I've had the conversation with some of my clients as to whether they contribute to a Roth because, you're contributing after tax dollars into that account and then it's tax-free when you withdraw it. But the issue with that is how the ATO might tax it when they're retired back in Australia. And I think we'll cover that very soon. But I know that's sort of a common talking point with expats. Do I do a 401k or do I do a Roth 401k? And what are the pros and cons and how's that going to be taxed and all those sort of, I suppose decisions. And I suppose they always need to layer their decisions with, are they going to be back in Australia or another country when I suppose it comes time to withdraw it. With withdrawals, and we've talked about the tax treatment side a little bit there, but what are the basic sort of rundown of withdrawals, retirement ages, those sort of things to access those accounts?
Yeah, so with your accounts, you got 59.5 is your age that you need to be to begin drawing on these accounts. You've also got what's called required minimum distributions on the 401k and the IRA. So these are minimum amounts that you actually have to start drawing on the plan. Now, you don't have those on a Roth IRA. And that's actually one of the reasons that some people would use a Roth over a traditional IRA or a 401k is simply not having to be made to withdraw money from that account. Whereas with the IRAs and the 401ks, once you reach 73, then you have to start drawing on that money. So
Yeah.
that's one of the reasons. I think the other reason is down to your sort of income planning and tax planning, and if you're going to have a higher level or a lower level of income in the future, and that determines on whether you're looking which route you want to go down with the plan.
Yep.
There are instances you can access the money under 59.5, but generally speaking, it is 59.5. With 401k, an example could be a permanent disability in terms of being able to access it before that age. With an IRA, you've got a slightly wider scope in terms of what you can access that money for that age. For example, purchasing a home, education costs. But even within those realms, it is quite narrow and restrictive in terms of how much you can take, what scenario is, what's your situation, how is this your first home, or when's the last time you owned a property, and the restrictions.
I was going to interject because that's kind of similar to, I guess, Australian super, where the age is very similar. We can't technically access super until 60. Tax treatment's obviously very different compared to the US, but 60 is sort of your preservation age, and that's what we call it in Australia. And then if you're still working up to, say, 65, you can only technically access a portion of the account. But similar to the US, if you are made, I guess, permanently disabled or, permanent capacity, there's provisions where you can access it early. The home buying, that's an interesting one. We do technically have that in Australia. The first home super saver scheme, but I haven't seen it successfully used by too many people, to be honest, because the amounts that you can get out of it aren't much, to be honest. But that's interesting because there are some similar provisions there. I guess with the with 59.5, when I discuss withdrawals with clients, they sometimes talk about the concept of trying to withdraw it early, and if there's any penalties in that. Can you share any insight into that?
In terms of the penalties of accessing
before 59.5, yeah.
So you're going to have a 10% penalty applied, as well as your income tax rate on those withdrawals. So again, these vehicles really are meant to be for retirement purposes, and I think if there's, if you've got a different objective in mind, then you would probably look at a different type of account. With the Roth IRA, it's slightly different. You still got the 10% penalty, and that actually also, if you haven't held the plan for 5 years, that can also apply even past that age. But you can generally withdraw your contributions at any time.
Yeah, great. And I think we briefly touched on it before, but generally tax treatment. So you mentioned then, if you're pulling out money early, say before 59.5, you get hit with a 10% penalty tax. How are they typically treated when you're just, say, drawing a bit of an income stream from it after 59.5? How's it taxed then?
So with your 401ks and your traditional IRAs in the US, it's going to be taxed at your income tax rates. The Roth IRA, as we sort of touched on earlier, because you're not getting that tax relief up front, when you take that money out of the account, it's not going to be taxed. So it's sort of the trade-off in terms of which end that you're taxed at.
Yep.
Now, if you have moved back to Australia and you're now tax resident over there, then the tax treatment is slightly different. So they're still taxed. So 401k, IRA, and really what you're looking at is that it's two components: the capital, essentially the contributions, and then your growth income, and that's the element taxable in Australia. Now, what really makes the Roth IRA pretty unappealing from an Australian tax residency standpoint is that is taxable in Australia. So whereas with the 401k or your traditional IRA, you've had that tax relief up front, so you're not really too unhappy about the fact that you got to pay tax when you take it out. No one wants to pay tax, but you kind of accept the fact that you had the tax relief up front, so
that's it.
You're never going to take it out.
Yeah,
whereas with the Roth IRA, you've not had that tax relief up front, so then being told you've got to pay tax when you take it out, that's a bit of a stinger. And so, yeah.
It is. And I know in Australia, I mean, you're spot on. The growth component is taxable, and I think accountants have a really hard job in Australia when it comes to sort of a returned Australian expat from the US, and they're pulling out, say, an amount each year from the 401k as a retirement income stream, and they've got to sort of work out what's the growth component and then what's the capital component, which is exempt. Always going to have some withholding tax coming out of on the US side because it needs to be taxed at source, needs to be taxed by the IRS, and then at least we can use that tax credit on the Australian side. The only not issue is, I guess you could say, or the pitfalls of the Australian tax system is our tax rates are really high, a little bit higher than the US's federal tax rate. So it often means that you're paying a little bit extra tax to the ATO, but you're getting that tax credit, which is really good. And then the Roths, I mean, the Roths are an interesting one because you don't get a tax credit at all on the US side because it's obviously, like you said, it's already after tax and tax-free on the withdrawal, but then you're paying tax on it again. So what I discuss with clients is, a quick hypothetical means you technically double tax on that amount, and the tax rate or the average tax rate can be really high because, as an example, if you're a high income earner in the US and you're putting an after-tax amount into the Roth environment, that means you might have had to pay, 35 or 30% average tax on that, and then you're withdrawing it, and then you're paying maybe an equivalent of 15 to 20% tax on the withdrawal on the Australian side. Well, the average tax rate then is quite high, to be honest. So you are getting double tax, especially on the Roths. And I know there's always the conversation, if you can withdraw the Roth before you come back, that's probably going to be a really good outcome but as you said, there's eligibility requirements around that age, those sort of things, 5-year rule as well, as you mentioned. So it just goes to show that navigating this space, especially towards retirement, it can be really complex because it's like, oh, do I do a Roth? Do I not do a Roth? When should I withdraw a Roth? When should I start withdrawals with a 401k? What are my other retirement assets? How's that going to be taxed by the IRS? How's that going to be taxed by the ATO? I would say a lot of expats get bogged down around trying to make those sort of decisions, and I guess that's why you and I exist. But mate, that's been a really good special episode today on Expat Chat. To our listeners and viewers, I'm going to get Ed on a few more times as we wind out the end of the year and we lead into US tax season as well. So keep an eye out in the social for those episodes that are coming out. Ed, really appreciate your time today and look forward to having you on for another episode.
No, I really appreciate you having me, and it's been good to talk about some of these topics which come up so frequently.
Easy, mate. Thanks and guys, thanks for tuning into today's episode.